plenty of domestic cues to tackle at this point in time, and we have with us Meherboon Irani of Ginny Gems Consultants. Good morning, Meherboon. You know, all of last week, one big theme playing was this RBI board meeting, and will they ease the norms for some of the banks? And of course, the public sector banks did well. What's your sense? Is there something more to fish over there?
I think this easing of PCA norms, and now I think somewhere I believe that with the macros changing a little bit, market somewhere is even possibly looking at the possibility of a rate cut coming, and that is getting built in. Now coming back to this easing of PCA norms and possibly some of these stocks which had possibly been battered down or hammered out of shape, coming back to life, is it a buying opportunity? I would say if a person is ready to wager money with the possible consequence of losing it, he can possibly go and put his money. But from an investment angle, I still believe that certain beaten down NBFC stocks had reasons to be beaten down. Things are not going to improve from them, or at least for the next couple of quarters. So I would say names like maybe an India Bulls, Divan Housing, those type of names, I think there is a potential. I'm not disputing it. But to a person who believes in pure fundamentals, wants to conserve his money, doesn't want to take any element of risk, I think he would possibly still stay away from discounters, while there could be an opportunity on the higher side from a trading angle. But not many people know when to exit. Entering is fine. Coming to the other point, I think somewhere I believe with the changing macros, I think there is an opportunity in public sector banks. At least one or two names should be there in an investor's portfolio. One main reason is they are highly underowned. You ask 20 retail or HNI investors, do they own any public sector bank? And the answer would be a clear-cut no. Because they are underowned, and if you believe that some recovery of bad loans will ultimately come back into the books of the banks, I think there could be an opportunity. And some of the higher beta names in PSU bank names, maybe something like a Punjab National Bank or a Bank of India, if not for an SBI, which I think is possibly the best bet in the PSU banking space, one can possibly buy from a one-year angle.
Okay. Meherboon, hi, good morning. I wanted to discuss one stock that has once again resumed its uptrend, it seems. That's HUL. I mean, over the last 3 months, it's gone from 1500, now back closer to its all-time high of, 1870 or so. First, of course, on this stock, and do you think the consumption theme is coming back?
I suppose so. The only question mark is in terms of valuation. And I think I recollect that at least 3 or 4 times I have been recommending Glaxo Consumer, the GSK Consumer, mainly because...
When you say consumer, you mean staples?
Consumption staples, yeah. And I've been recommending consistently GSK Consumer because Horlicks was supposed to be sold off. Ultimately, HUL has taken off. And allow me to state, it's a great positive, because I have tracked this sector quite closely. I have tracked the sale of Horlicks, and I personally believe HUL will do wonders to this brand. GSK Consumer, while being a great name otherwise, I think if you look at the operational cost of running a Horlicks, along with this network, I think it's nothing as compared to what HUL can provide. Now the point where Sonia asked, as a stock, I think if I go back to October, HUL was somewhere around 1550. And just before this deal was announced, maybe coincidentally or otherwise, the stock had already run up to around 1800 rupees. Now, should one buy HUL at the present level, I think there is a possibility the share could correct here and there and would not give too much of returns in the shorter term. But if you believe in the Horlicks story, if you believe that over the next 1 to 3 years, Horlicks will ultimately add in a big way to HUL, which I believe it will, I think from a pure consumption stock angle, even at 1800 rupees or 1825, I wouldn't mind recommending or advising my clients to buy into HUL.
Okay. Just waiting for the markets to open. We still have a little bit of time. What is the call now on Motherson Sumi? We saw a sudden acceleration after a long comatose move in Motherson Sumi because China was believed to be bringing on tariffs on foreign cars.
I think over the last 4 to 6 quarters, I have gone a little bit negative on even a stock which I otherwise liked, maybe for 3-4 years in a row, Tata Motors, mainly because I had become very skeptical about a year ago on global auto sales. And I think the story is playing itself out. Things are just becoming from bad to worse as of now, as far as global auto sales goes. And Motherson Sumi, I have always believed is a global player. So maybe with the couple of acquisitions which it has made over the last 2-3 years, I think, plus the pressure as far as global auto sales goes, I think the stock has taken a sharp beating. I think a little too late to possibly book profit in the counter, because over the last 2 years, the stock has just done nothing but possibly giving a little bit of red to the portfolios of investors. At the present level, I don't have any possibly reservation in recommending the stock, but I think this stock will take its own time to recover and start giving returns to investors, because I still remain a little bit skeptical on auto names and auto ancillary names for some more time to come, till the time sales actually pick up.
Okay, we'll come back to you for more. Thanks for that. But for now, after a very tumultuous 2018, how are the markets poised for 2019? So it'd be a nice spoke to market veterans, Shyam Shekhar, Ramesh Damani, a whole host of them, many of whom you don't even get to hear. So let's listen into some of their views.
From one bull market to another, the leading themes tend to change. Of course, you have the evergreen stuff like consumption, but there have been bull markets in which consumption has also done badly, and there was an opportunity there. If you see the current bull market, I think the opportunity lies in basic industries and capital goods, because they have not participated since 2008. You have not seen much of capital formation in these industries. Asset creation has slowed to virtually standstill. You have seen that the banks lent money and assets went bad. So we are only spending the last 5 years trying to clean up all this.
Okay, actually listen closely to that. The opportunity this time may not be in consumption in this cycle. It may be capex. That is the theme we are going to discuss today with Neelkant Mishra of Credit Suisse as well. So all these bites are really preparing you for that. But for the moment, of course, we are preparing for the markets itself. The Nifty opening with a slight green tick. I think we should see a little bit of red on the currencies. That's because you had a strong dollar finish. Although the current account the trade deficit number for the month of November is actually a positive, you could see a slight weakness in the way in which the rupee opens. Now the Sensex and the Nifty are running away, so we are seeing a very strong opening. Well, I guess we should take it with a bit of a pinch. Let's wait for the markets to settle down. I guess Vedanta is one stock we'll have to watch out for.
Yeah, Vedanta, and maybe it's, the Santa Claus rally that everyone keeps talking about.
Strong. I think the current account, the trade deficit number is clearly making markets a little happy.
Okay.
And we are not overpowered by the strong dollar.
Yes, the rupee has opened 71.79. I mean, not
10 pice stronger.
Yeah, 10 pice stronger. It fell 20 pice on Friday. It's recovered about 10 pice. So, by and large, within that range itself, about 71.80 to 72 rupees. A couple of stocks to watch, NTPC and Power Grid. Those draft tariff regulations were released on Friday evening. And as Anisha was telling us, there was an expectation of 100 to 200 basis points cut in the regulated ROEs. But that was the expectation. But no cut has come through. So, it's just going to be 15.5%. And that's something that the street definitely likes, these two stocks in the green. In fact, SP Tulsian of sptulsian.com joins in. Mr. Tulsian, good morning. What did you make of the draft tariff regulations that have come through, and how would you, as a long-term investor, would there be any opportunity in names like NTPC, Power Grid?
See, Sonia, I don't think that there is any kind of disappointment on the regulations or maybe the draft reports which have come. But if you really take a call on the NTPC kind of stocks, I'm not keeping a positive view. In fact, overall, if you really see the situation on the power generation front, even I'm not keeping the positive view, because the situation, seem to be problematic even at the end of the DISCOM, still in payment realizations, and the volatility in the power rates and on the spot power rates being seen, which has not been able to capture by the power generator. So overall, this sector per se is not remaining within our positive list.
Okay. Good morning, Mr. Tulsian. How do you approach Vedanta now?
See, positive news, Lata, definitely, because the Tuticorin plant will again, once starts contributing to the top line and bottom line, that will be seen positive, because this has been a big relief for the company. Now, obviously, the litigations will go on. We will definitely be seeing the appeal being preferred against the NGT order to Supreme Court. But again, I don't know. But maybe even there they have a strong case. So let's hope that the positive at the apex court level also comes in favor of the company, and that will be seen quite positive. But till then, maybe in the interim, the developments, the commencement of the plants, how much time company takes, and the preference of the appeal by the state government against NGT order has to be looked into.
Okay, well, a couple of more stocks that are moving up. Vedanta, of course, is up 10% as we just spoke about. A couple of these metal names, JSPL is up almost about 1.5%. Hotel Leela has some corporate action going for it. It's up about 5%, but it's still a 15 rupee stock, so don't lose sight of that. And Future Consumer is up almost about 2.5% or so. Before we go back to our fundamental guests, Prakash Gaba, quick thoughts on Vedanta. I mean, I don't know if this 10% up move may play out, but at around this 200, 220 rupee level, how does it look?
I think I like it from a slightly longer term perspective because short term it's gone up. Maybe if it see a dip, that's a buying opportunity. Strong support in the vicinity of 200. I think it can climb to around 210 zones. Looks good from a slightly medium term perspective.
Okay. Mr. Tulsian, I also wanted to ask you about Biocon. Ekta was telling us that competitor Teva has also launched the same drug that they have, that the Biocon Mylan group got approval for. What's your overall view on the Biocon stock?
See, Lata, we have been keeping extremely positive view on Biocon because if you really first, if I go by their Q2 numbers, till they've posted, their small molecule and biologic division both have really shown quite a good performance, and in fact, API the unit of Telangana got the USA FDA clearance. So all these things are seen positive. One may argue that the Teva may give competition, but if you really take the situation on the valuation front, because as such the Biocon is ruling at a P multiple of about 35 or so, anywhere between 33 to 35, while the Asian biosimilar drugs are seen, commanding a P multiple of maybe 50, 55. So your valuation differential, is seen to be much in favor of Biocon, and in fact the financial performance of the company has been seen on a quite good improvement. In fact, if you see their API in the small molecule division, if you see their API realizations has really gone up in Latin America, Europe, and Middle East geography. So all these things are seen quite positive, and we are keeping positive view on Biocon.
Okay, well, since we're talking about pharma stocks, Aurobindo Pharma is also trading in the green this morning. Sources have told CNBC TV 18 that the Unit 4 inspection was closed. It was inspected last week, and Unit 4, remember, is Aurobindo's injectable unit. The inspection has now been closed. Aurobindo Pharma, Mehrbun, any thoughts there? I mean, it's a stock that is, that has seen a big move. I mean, over the last 6 months, it's gone from about a low of 600 to a high of almost 850. Do you see more upsides here?
Honestly, over the last 4 years, I've shied away from recommending anything in domestic pharma companies or Indian pharma companies. In fact, I'm very, very negative on them. I had gone to the extent of saying that it's a wastage of time investing in pharma stocks. This is 4 years ago. I think the only two pharma stocks I liked are both MNCs. One is Abbott and one is Merck, and I still remain positive on them. So barring trading opportunities here and there in the Lupins and the Ciplas and the Glenmarks and the Biocons and possibly in Aurobindos, I don't think it's worthy of investment even now, because the concerns for the sector, starting from the regulator to the pricing to the molecule discovery, I think it continues.
Okay. Mr. Tulsian, for the umpteenth time, I'm going to ask you about PSU stock, PSU banking stocks. The Reserve Bank board meeting didn't yield anything, but there is a continued expectation that some of the banks will be pulled out of the prompt corrective action, that more capital will be given in some fashion. There is a lot of hope about public sector banks. Then there was this big upgrade coming on SBI by Morgan Stanley. All told, your approach to the sector, your picks.
See, Lata, if I just take the call out of the PCL list, obviously SBI forms as the top pick in the list, and one can go with the stocks like Bank of Baroda, Punjab National Bank, and Canara Bank, all non-4 PCA banks. Now, coming on the PCA banks, definitely, in fact, that is what I've been saying, that if you take a call on 3 banks, I'm in fact to be being selective out of 11 banks. I'm presuming that IDBI Bank, maybe theoretical purposes, continues to be in the PCA list. But you need to knock off 3 banks from this PCA list, that is IOB, Bank of India, and OBC. Because if you really see the consistent financial performance, I'm not coming on the rule tweaking, whether the capital adequacy ratio will be reduced from 9 to 8% or 7%, Basel norm said 8%, and maybe the net NPA, if it falls to 10%, 6%, all those, the points of argument. But overall, as a fundamental analyst, I won't be taking a call on the PCA, because maybe the tweaking of this rule and taking out some of the banks from the list of 11 banks, which I say that it's only 10 banks excluding IDBI. So maybe that will take little time. So as a fundamental investor, I will be rather more interested in buying the shares, as I said, SBI, Bank of Baroda, PNB and Canara Bank. But yes, one can keep an eye on the PCA banks more from the trading perspective, but not from investment perspective at this point of time.
Okay, so that's about the banks, but you just heard the 2019 outlook from Shyam Shekhar. Let's hear it out from someone you don't get to see very often, Govind Parekh, with his view on fertilizer, sugar and the pack. Also Ramesh Damani and Ramdev Agarwal with their views. Listen in.
We bought EID Parry. We've been holding for a long time. It's got very deep value in the company. Each EID Parry share holds a Coromandel share. So if you see, the discounting is so big. They have zero arrears. In fact, some of the executives I met, they said, we are fools actually. All over India, everybody has got cane arrears. We have zero arrears. But these things help in bad times when there is, less rainfall. I mean, Tamil Nadu, there has not been rainfall at all last 2-3 years. So in these times, when others are having 80%, say 60-70% shortage of cane, these people will have 30-40% shortage of cane. Coromandel is growing very well. Fertilizer industry, I think the problem in fertilizer, I can talk at length on that. It may be boring for everybody, but fertilizer, basically the policies have to change. The phosphatic fertilizers and urea is subsidized and phosphatic is not subsidized. So government can do that in the first year. It's very difficult to raise the urea prices, So once that happens, this Coromandel will become a, huge story. It may happen, in the next government comes to power. A lot of things are going to depend on the international scenario. My opinion is that there will be a lot of volatility in the market. So themes as such, capital goods, of course, they have to do well if India has to grow at 7-8%. And I think even entertainment sector, casinos and hotels and properties in hill stations and all that will do very well. Because the number of working hours is going to reduce substantially over a period of time. Most of the people, then what do they do? So, and today with the communications, I can sit in Kunur or Kodaikanal and do the business. I don't have to buy a property in, proper Chennai. So, and a lot of people will go on holidays. I think that sector, airlines, all these things are going to do extremely well.
No, actually, gaming and hotels may do well, but this theory that working hours will come down, I don't know. I hope they do. I thought WhatsApp is actually making the working hours stretch endlessly to maybe 23 hours.
I think his basic point is that you don't have to go to an office and work. You can work from home or work from a hotel.
Yeah. So hotel stocks, I take the point that there will be more people having more time for leisure. Okay, we have to get our 9-10 stocks and then we are coming back to you, Meherboon. Sudarshan, your 9-10 call?
Well, it's Havells. The markets are opening cheerful and Havells has been an outperformer. So buy Havells with a stop under 695 and a target of 725.
Okay, so the light in your life for the day, Havells. Mitesh, yours? Mitesh, we can't hear you.
Yeah, I would choose NIT Tech. The stop loss would be closer to about 1119 and the target should be 1180, and maybe in the next 1-2 days you could see those targets.
Okay, and Prakash, what about you?
I also have NIT Tech, target on the upside 1175, stop 1110, NIT Tech.
All right.
Okay, well, Meherboon, IDFC Bank has caught your eye.
Very much. I think it's been a very, very, very long time, after which even I'm looking at a holding company, and even IDFC Limited looks good. But coming back to IDFC Bank, if you ask me, I think this is a very simple case, and that's the way I'm looking at it. A clear doubler from here in maximum 2 years. I think the company is ramping up its provisions consistently, writing off its bad loans, and provision coverage ratio at the end of quarterly one was around 77%. The management has clearly stated that over the next 2 quarters will continue ramping up provisions, and the provision coverage ratio could touch even 90% by the end of this financial year, second only to HDFC among banks. With Capital First merger coming through possibly by the end of the year, with Mr. Vaidyanathan taking over, a completely scrubbed, clean book. You can look at return of assets improving from 0.6% to maybe around 1% for the merged entity, and return on equity going to 10%. Now, you may argue, what is so good about these numbers? The point is, I'm not saying they're great, but the point remains that the direction turns positive. Shareholders get a completely clean book as far as the bank goes. there is very low risk on bad loans going ahead, and there is a clear-cut risk, upside risk for growth coming ahead. The retail assets become 30% of the books. So I think I would give it a one-time price to book value. Right now it's 0.5 times. Even if you take a 10% growth, the book value should be around 17,000 to 18,000 crores. So one time, right now it's quoting at 0.5 times. So a 38 becoming a 75, 80 over the next 2 years, according to me, is pure common sense, according to me, unless the new management starts taking too much of risk, which I believe under Mr. Vaidyanathan, that will be largely taken care of.
Okay, thanks a lot, Mehrboob, for joining us and giving us your views. We just have about 1 more minute left before the market opens for the day. Let's get a quick snapshot of what's happening in the commodities space today. Manisha Gupta, commodities editor, is here with us. Hi, Manisha. Good morning.
Morning, Sonia, and thank you so much for that. Well, after the kind of declines that you have seen in crude oil prices for the month of October and November, December clearly has been quite positive. So a third straight week opening firm for the crude oil prices there. The markets are looking at the US drillers who have cut rigs yet again for a third straight week. So when you look at the US rig count right now, that is at a 2-month lows, and that of course has been supportive. The markets also will continue to look at the kind of output cuts that we will finally see from 1st of January. While of course there are demand concerns from China and Europe that the markets are seeing right now, but much would depend upon in the month of January on what kind of output cuts do we actually see on ground, and that is where the price cues would come in from.
Okay, thank you very much, Manisha, for joining us. Well, actually, we have only a few seconds for the markets to open, so let us thank Mr. Tulsian as well. Mr. Tulsian, of course, we are going to touch base with you on closing bell with lots more questions. But at the moment, shifting focus to the markets, it's about 0.4% higher, which is a much better performance than any of the other Asian markets. So let's see if we can keep that going. At the moment, Vedanta is the one and NTPC leading the pack. Okay, it is a 0.4% gain. Almost, all right, now it's slipping up just a wee bit. 0.3, 0.38, 0.4. So we have opened pretty much at the pre-opening levels, and the Nifty Bank is only mildly underperforming at this point in time. I mean, it's 0.35. Not a long haul. The mid-cap as well, not doing as well as the Sensex, which is 0.5% higher, but you can take a 3% gain with both hands. Sorry, 0.3% gain with both hands. Power Grid and NTPC and Vedanta. Expected stocks lead the pack. Power Grid 4.5 higher, Vedanta 4.5 higher, and NTPC 3.2 higher. Those are the gainers. Yes Bank is continuing with its climb, 2%, expecting some softening perhaps from the Reserve Bank, or the fact that at least non-executive chairman has been chosen. Hindalco is still up 1.2, so the metal stocks are not doing too badly. JSW as well up about 1%. IOC is up about 1%. HDFC is up. So actually it's a good mix. It's metals as well as some bit of oil stocks that are doing well. HDFC is the biggest finance stock other than Yes Bank, which is doing well. And then comes IndusInd Bank, also up 1%. You have some pharma stocks like DRL doing well, HCL Tech doing well, Adani Ports. So it's really a fairly broad-based recovery in stocks, or rise in stocks. Just about 5-6 stocks that are in the red. Z Entertainment, Bharti Airtel, BPCL, Hero Moto, L&T, Asian Paints, HUL. Obviously, they've all run up a lot, and therefore you're seeing a shade of red. Not a very big fall at all.
Oh, not at all. In fact, it's a good opening for the market. After a 1% rally last week, the index has opened about 0.5% higher already. And, even the mid-cap index is up about 0.5%. Advance decline ratio is pretty good, almost 3:1 in favor of the advances. A couple of pockets are looking good. Of course, Power Grid and NTPC we spoke about. They're the top gainers right now, more than 4% higher. So is Vedanta, all news-based stories there. But a couple of these NBFCs also, Group Finance is up almost about 1.5% or so. A couple of the others, PNB Housing Finance, these home finance companies are picking up, the quality ones that is. Glenmark Pharma had some positive news flow going for itself, it's up 1.5%. Max Financial, that stock at the start of December was at about 60 rupees or so. No, Max India, I think. Max India, we should get that up for you. Max Financial is also up in the green. But that whole group is looking pretty good. Max India is up 4% now. At the start of December, it was 60 bucks, and now it's almost at 85 rupees. So look at that move over there. And a couple of others, Future Consumers up almost about 2.5%. And some of these metal names looking pretty good. The other theme that's playing out is pharma. So you have Divi's Labs, that's up almost 1.5%, Cadila Health, Glenmark Pharma, that whole lot is up about 1.5% or so. Good opening for the market actually. 10,860 is being held, and the big movers, Yes Bank once again gaining the charts, topping the charts, 1.5% higher over there. So Darshan, after this kind of an opening, do you expect to see any follow-on buying? I mean, you did mention that earlier in the day, but what do you do at this point?
Well, you can go long now, or as I had suggested, go long after half an hour. But I think the markets are showing enough strength to suggest that they will maintain this level, so at least in the early morning trading. So the trade is to be long in the Nifty and the Nifty Bank both. Your stops in the Nifty are to start with 10,750 and in the Nifty Bank 26,650. But these stops can be raised during the day.
Okay. Is there any specific bank you would go with? I mean, I'm asking you because in banking, the honors are very evenly distributed. Yes Bank, Bandhan, Equitas are all up over 1%. Then come the big boys, HDFC, IndusInd, which are up exactly 1%. And then come a lot of public sector banks, which are up about 0.5%. Where would you put your money, Sudarshan?
Oh, it's ICICI Bank. That's the bank that was not doing anything. I think it should catch up and do much better today.
Okay. Mitesh, what have you noticed? What would be your 9:15 call?
See, Lata, I think HDFC has started really well, so that could see more traction on the upside. I like Vedanta also because with this kind of big gap, I think there will be likely follow-through plus short covering happening. But the only thing is that you need to wait possibly for another 15-20 minutes. If there's some kind of intraday profit booking happening over there and a dip can be bought. So around 207, 206 if I get it. Keep a stop below 200. I think 220 should be the first target over here.
Okay, so that's on Vedanta, 220 as the first target. Prakash Gaba, does it make sense to go long now? I mean, it's picking up pace as we speak, you know, so almost 70 points higher on the Nifty. Would you advise taking fresh longs here? Why not?
I think it's so far good. The technical target that I had is around 10,878. I think it's come back closer to that. It's achieved. But it's going beyond that to 10,911. So it's still good, okay to long. Only thing is, where do you put a stop? I would put a stop deep below 10,770. So even if it dips, it's a buying opportunity. It's going up. Certainly.
All right. These are two stocks that I guess I'll ask, if possible, to all of you. Power Grid and NTPC, Sudarshan, V-shaped recovery, and there is now a bit of guarantee about their future earnings with their rate of return being protected by the draft rules. They're not final rules, they're draft rules. Look at the rally in both those stocks, 4.5%. Would you climb on even at these levels?
No, I would not. In fact, while they have done well for the last few days, they are actually in deep bear markets for a longer term. I would wait for much more price action before taking a buy.
Okay. And another stock I wanted to ask for a trading bet is actually Relcom. It's been doing consistently well. I mean, okay, it may be a small value stock, a penny stock now, but December has been very kind to that stock, and there have been some domestic positive reasons as well. Is that a stock at all, Mitesh?
See, I think the chart structure is definitely good because, you know, last week also we saw very good traction and then mild pullback and consolidation around the 200 average. I think it will go up. I mean, I'm not a fan of Relcom to trade personally or even recommend it. But I think after such a beating, I think the charts do suggest 17.5, 18 could be the first target. Maybe 19 could be visited there as well.
Okay, well, gentlemen, we will thank you for joining us on that note, and with the view that the market has opened up well in the green. It's holding on to its gains. In fact, now 250 points higher on the Sensex almost. A pretty good start, we must say, to the last 2 weeks of the calendar year. But let's discuss some thoughts on, you know, how to approach the new year. Credit Suisse has just released a fresh report laying out their big theme, a preference for investments over consumption, on the basis that an improving relative PE should support the industrial outperformance. Neelkanth Mishra, the MD and India equity strategist at Credit Suisse, joins us now to talk about that. Neelkanth, hi, good morning, and greetings of the season to you and your entire team at Credit Suisse. I was just going through your note where you say that the gross fixed capital formation numbers, which is the broadest measure of investments, have revealed some surprises, specifically with respect to private capex. Can you just take us through what the gist of your report is and why you're so bullish on some of these themes?
Yes, thank you, Sonia, and wish you and your team as well season's greetings and a great new year next year. The see, the gross fixed capital formation, which is the most broadest measure, as you said, that's what everyone tracks. And there was a very sharp decline in the GFCF to GDP ratio. That's the broadest measure of investment that you can see. This has been correlated with, see, in our markets, in our part of the world, everyone is looking at investment stocks, investment revenues, and it so happened that it coincided with a decline in industrial earnings and a price to earnings as well. So we investigated this, and given that in the last 6 quarters, GFCF to GDP ratio has been climbing quite steadily, the question was, can this sustain? What we found quite surprisingly, if you drill down into the GFCF, is that most of the slowdown has come from the informal sector. In fact, private corporate capex has been growing in the mid-teens, actually 14% CAGR. Of course, the machinery capex was up only about 10%. 10% is still much larger than what we had expected we would see. In intellectual property investments have been growing at 22% a year. So there is still quite a bit of investment actually happening. What was surprising to us was that household, even in nominal terms, there was effectively no change. The third big surprise was that, contrary to consensus view that the government has been responsible for the pickup in capex, actually the government sector has been investing at the same pace for most of the last 7-8 years. So the GFCF to GDP from the government side, the public sector side, has actually been flat. So, the pickup that we are seeing is not really government. Secondly, the fact that the GFCF from the government, the public sector, has been keeping pace with GDP means that it's much more sustainable. So it's not that it's suddenly going to dry up as governments compete with each other on fiscal profligacy. So which makes this actually much more sustainable. And lastly, on the private corporate side, then we took a list of 12,000 companies and looked at their capex. And what was quite surprising was that the slowdown seems to be only in a few micro segments. They're not micro really. I mean, there are 2 segments, metals and power. And now we think that steel capex has started. Our view remains that power capex also in 2-3 years will start off. So I think that this is setting the ground for a very meaningful and sustainable recovery investment activity.
Okay. Good morning, Neelkan. We were hoping you would be with us and you will be able to even participate in interviewing some of our guests whom we have fixed on the basis of your report, actually. But yeah, maybe you can join from that remote studio as well. Just one detail before I delve more. What is the percentage composition of informal sector, private capex and government in this gross fixed capital formation basket?
43, 25 and 32. So 43% is private corporate, 25% is PSU, public sector, and 32% is household. So to give you the numbers as well, so see, of that 25, that is public sector, about 2/3 comes from state government and CPSE. So central public sector enterprises, and a very small percentage is actually the central budgetary allocation. For the private corporates, all of this is MCA 21 data. Right? So this is as solid as you get. The residual, and so household is actually the residual. So what you do is you take a proxy of overall GST, and let me not get into too technical stuff, but yeah, so that's the split.
Okay. I just wanted to come back to one point you made about the pickup in capex. Earlier, when there was a stagnation in capex, it also had slowed down a lot of bank loans to the industry, specifically, power and metals, which was at one point half of the sanctions, as you mentioned in your note. Now, how do we see that piece of the puzzle evolve?
Yeah, so that activity is also picking up. Now, as of now, that activity is picking up, well, at least at the margin, as you know, the insolvent companies are being taken over. So the more solvent companies are taking loans to take them over. But I think, and there was also a phase where loans were being written down. So I think the aggregate exposure to industry was actually starting to come off. And our sense is that that's been one part of the loan book of banks, which has actually struggled and stagnated. And if you see the relative underperformance of the private corporate banks compared to the private retail banks, it's been staggering. And now that bulk of the problems are now known, I think many of them still have to be recognized in balance sheets, but bulk of the problems of the prior cycle are now known. And the banks are getting enormous pricing power now that the NBFCs have sort of disappeared from the space. The pricing power is coming back, so there should be net interest margin expansion. On a relative basis, they have actually really struggled and lagged the market. So that is another area where we find opportunities.
Okay. I'm not surprised at all to see L&T, for instance. I mean, after all, even their Q2 numbers indicated fair amount of robustness, and the argument on SBI and ICICI is being shared across. We saw this big report coming in from Morgan Stanley. The intriguing name is actually BHEL. Nobody's mentioned that name. Power sector, yes. I mean, there are nobody's invested in power, but there are so many going for absolute disastrous valuations. The DISCOM problem has not been repaired at all. Why would anyone invest in a new power company? And if they don't, why will BHEL get orders?
So one of the things in the stock market that, and I know, Lata, you've been doing this for a while, so I'm sure you know this, but for the benefit of perhaps your viewers, one of the critical aspects of choosing a stock to be in, because it is, see, the company could be doing well, but the stock could be overvalued, right? So one of the first instincts is to look at stuff that no one else is looking at, right?
Okay,
and that is not good enough, because if you had done that with specific stocks that you mentioned, you would have lost money for many years. But now what we are seeing is that, look at India's energy needs. See, to grow GDP at 7%, you need energy supply to grow at 4.5%, because your efficiency gains cannot be more than 2.5% a year. Anyway, they're one of the best in the world. This is a note we had written in October. And if you have to grow at 4.5, how do you get that energy? Almost all dense forms of energy are imported. Oil, gas, metallurgical coal. The only thing you have is thermal coal and renewables. And renewables are not large enough. I mean, people think that it will solve our problem. I hope and pray it does. But on current economics, it doesn't seem to be in a position to meet our energy needs. So however unlikely or however environmentally unfriendly it may be, if you have to provide energy to people, you have to mine more coal and you have to produce more thermal power. Now, what has happened in the last, I think, year and a half or so, is that utilizations have started to pick up. You would say that, average utilization of 62-63% is nothing to be really excited about. But peak utilizations have gone up. You'll be surprised. I mean, I was at a village in northeast Bihar in about a month back. I mean, I was shocked. There was ice cream selling there. Now, what that means is that the cold chain is working. Now, I would not have wanted to have that ice cream because perhaps the cold chain may have failed at some point in that supply chain. But the fact that it was there was surprising. And the fact that the retailer is stocking that ice cream means that he has power for most part of the day. Now, if you have steady power, and that part, I mean, we used to expect 7-8 hours of power. Now we have 22-23 hours of power, which means that peak demand, peak utilizations have actually shot up. So what we are tracking is 62-63% utilization is the average level. But the moment you look at peak utilization, you're already in the 70s. And our demand is rising at 6%. So in 3-4 years' time, you are going to need more capacity. And if you're going to need capacity in 3-4 years, you need to start setting it up now. So, and I think that realization is not there in the market. I mean, people are worried about receivables for power equipment companies and for power generation companies. But the business reality, the economic reality is that you need more power.
Okay, that point is very well taken. In fact, it's not something
I think I could have gone on with this, but I know we have to take other themes with Neelkanth. I would have normally thought then you should have Tata Power, CESC, Adani Power, Coal India, all those in your list. But anyway, I think that argument for another day.
Yeah, I know we can actually talk endlessly about this.
No,
we have
so
please, go ahead.
No, but So on utilities, so we did go overweight on utilities at that time. I will not take specific stock names, but we do think that that ecosystem is unloved, underheld, and has reasonably good prospects.
Okay. Actually, I wanted to talk to you, Neelkant, about your caution with respect to NBFCs. I mean, you have mentioned it several times in your report about the slowdown, etc. But that's not echoed by, the views that we got from Keki Mistry. I mean, we just spoke to him less than 2 hours back, and he said that confidence will return once again in the industry. In fact, a lot of CPs are getting paid off as we speak. Where does your concern stem from then?
No, I think if you are running any business, you're not thinking the next 6 months or 12 months, right? When you set up a business and you're running it, you're thinking. I mean, companies theoretically are forever, and so do the private sector, non-banking finance companies have a great future 10-15 years out? Absolutely, they do. Are we going through a bad phase in the cycle? Yes, we are. And I don't expect this to be, and let me first say that, there's a lot of loosely used phrases like India's Lehman moment and all that, which I think is very irresponsible. There's absolutely nothing like that. This is, Indian NBFCs are very well capitalized. We're talking about assets to equity at 4.5 for the NBFCs and 7.5, 8 for the HFC. So there's no risk of cascading defaults and the whole system shutting down. But at the same time, what is happening is that there is a problem of growth. That many of the NBFCs, especially not the ones or the ones that do not have a known corporate brand name, and therefore cannot rely on access to liquidity even when there is high amount of risk aversion, they're actually slowing down. Some of them have shrunk. Their balance sheets are smaller now than they were end of September. So this is what I'm worried about. I'm worried about the lack of growth. I'm not worried about cascading defaults. There could be 1 or 2 NBFCs where balance sheets are an issue, but by and large, it's an issue of growth. And the good thing is the near-term liquidity has eased, so therefore things have started to move. But at the same time, the 1 to 3 year market is not eased, and that suggests that and if you really do not want to get into an ALM mismatch problem again, then you're not going to be growing too much, and that's why we think that this will have a drag. This is very negative for growth. There are dealers, distributors who relied on loan against property to get funding, to get working capital. They are slowing down. There's a lot of evergreening stuff which was, I think, starting to happen, which I think slows down. There could be some risks of, so while the NBFCs are now safe, are their borrowers as safe? They're a very fragmented set. I don't think there will be any massive defaults, but at a very fragmented level, you'll start seeing problems emerge. And till those problems are discovered, because in aggregate, I don't think they're very large problems, but till those problems are discovered, I think there will be some uncertainty, and the NBFC ecosystem will grow a lot slower than it was in the last 3 years. That's all we are saying. We are not saying that they don't have a future. You need massive penetration of formal finance in this economy. I think the technology changes and the excellent management teams that they exist, I think they have a great future, but not, I think we need to see a lot of correction before we embark on the next upturn.
Okay, now let me come to the other part of your report where you say you prefer investments over consumption, and you're not very confident that consumption normally picks up during election time. We are going to be shortly joined by Dr. Pranab Sen, who's made this observation, and he's an economist who has seen many of these cycles. So we would invite you to stay on and even question him if you wish. But Neelkant, there is a concerted move to ask public sector banks to lend more. Either they be brought out of prompt corrective action. There is also a separate move to use Reserve Bank capital to capitalize banks. We don't know what will come of it as of now, but the market is definitely playing that hope trade that maybe 2-3 lakh crore will be available. They will be able to write down some loans or write off some small loans and even have growth capital. You don't play this theme at all? You don't think that's a possibility as well?
Possibility, everything is possible. We play on probability. Okay, so I know I've heard these arguments. I think there's good reason behind them. The underlying reason, let's look at them. And I think these issues and these discussions will keep happening for the next 5 years, maybe more, is that 40% of your workforce is in agriculture. We've been highlighting for the last 2.5 years that, look, now we are done. Right? Demand growth can't happen, productivity is rising, prices will fall, people have to move out of agriculture. Hold on. So this is a political problem.
Yes. I'm looking at something.
This is a political problem. Politicians will want to solve it.
I'm looking at something more of a trading issue now. I mean, looking at consumption theme for the moment. See, interest rates look like they will fall. You may bet on a rate cut or you may not bet on a rate cut. But looking at the way in which inflation or disinflation has taken over, you have to expect market yields to soften. You've been promised a giant liquidity by the Reserve Bank, by a normally very wary Reserve Bank. You've got a promise of, I think, 40,000 crore of OMO purchases. And, there is the normal election purchase, election handouts that come from political parties. You still don't think consumption has a damn good chance?
That's where...
At least for 6 months.
No. No. So I wish I could time my stocks that well. But see, the thing is, there will be rhetoric. As I said, it's a political problem. There are a large part of our fellow countrymen who are under stress, and I think at least there has to be an attempt to solve those problems. But in the markets, when we look at prospects for companies, we have to look at what is likely to happen, not the rhetoric, right? So, what can they do? Which are the states where loan waivers have not happened? I mean, you don't need a loan waiver in Bihar because there's not much credit there anyway. Most of the states which had big loan exposures, Maharashtra, UP, they already happened. What else will you do? Can you do a Raitu Bandhu kind of scheme in other states? Do you have clean land records? You don't. Is Raitu Bandhu itself a proven and tested model? I mean, 2/3 of the land is owned by 1/3 of land-owning farmers. There are 2/3 of the workers in the agriculture are landless. How do you transfer money to them? So the intent is there, and I think what we should be sort of comfortable with is that the political narrative, the political focus is starting to shift towards what it should have shifted maybe 10 years back. But the point is, can something happen? Can something support that consumption? I don't think there is anything on the table which is likely to happen. On the other hand, look at the pay commission, and this is something which I think gets completely forgotten even by companies. The 7th pay commission added 4,50,000 crores to salary and pensions on an annual basis, right? And imagine the consumption impact of that. See, unlike for, say, people in the private sector where there is an uncertainty in incomes, this is forever and this is expected. 1st Jan 2016 is going to start, so it will come 2017, 18, whenever the state decides. Maharashtra is, I think, the last one starting 1st Jan 2019, but then it's done. And therefore, the consumption impact of that is massive because you've been waiting for it, you've been planning for it, and you know it's going to come for the rest of your life. So this gives a spectacular boost to consumption. You look at two-wheeler sales, four-wheeler sales around 5th pay commission, around 6th pay commission, and now the 7th pay commission. It starts very suddenly, people are surprised, shocked, and then it's almost as if you've hit a wall. I mean, if you ask people in the markets and they say the car sales people, they're saying money's just disappeared because the pay commission is over. And I think that's something that is not something that people are really, because that is real money which was going out. The rest is all rhetoric. So while there will be speculation, people will keep buying stuff on speculation, but give me numbers. Okay,
I take your point. We had even the AC guys telling us that they have scaled down the industry growth. Remember, Mr. Tyagarajan said to 5%. As well, yes, I take your point on auto sales. But let me get someone who looks at the economy micros as well as you do, and for a much longer time, Dr. Pranab Sen, the former chief statistician and former chairman of the Statistics Commission, joins us. Good morning, Dr. Sen. I invited you for this conversation primarily because last time you told us that you would be a little more confident of the fourth quarter growth because consumption normally picks up in election season. What is your sense? You've seen the private final consumption numbers. They have been lingering around only 6 to 7% for the last 6-8 quarters. You think there is a chance consumption picks up, and even if it does, will it be only for a quarter, not sustainable?
Well, you see, the thing is that there are always second and third round effects. Once money comes into circulation, goes into consumption in that first quarter, in the pre-election splurge, that money stays around, and it does lead to second and third round effects. So it's going to be around for a little while, but you'll have a huge boost in one quarter, and then it'll start tapering off. But the fact of the matter is that may not actually solve the overall distress problems, because I don't think the sums are large enough to begin with. Number two, much worse, is that as far as farm loans are concerned, unless there is some form of forbearance, these will turn NPA well before those goodies start coming in. And then the farmers are in deep distress. Because then they get locked out of bank loans, they're pushed into the arms of the moneylender, and that becomes a permanent state of being.
Dr. Sen, good morning. I wanted to also ask you about this, the discussion we were having with our guest Neelkant Mishra, where he pointed out how in the gross fixed capital formation numbers, the key takeaway this time was a pickup in private corporate capex, something that we haven't seen for a while. Your own thoughts on this, and do you see this as a sustainable up move?
Well, the thing is that private capex has been reasonably high right along. It hasn't accelerated very much, but it's still been substantial. The real fall has come in the household sector, which is the unorganized sector capex. So if you're looking at change, there is a positive uptick, which is a good thing. But the fact is that it's an uptick on what was already a fairly buoyant private corporate capex. But nothing is happening at the household capex level at all.
All right. Well, then we are all on the same page. I was under the impression you were way more bullish on consumption, but you think that it will be only a brief wonder if indeed there is during election time, right?
Yeah, well, we were talking at that time about the fourth quarter specifically.
All right.
We were not talking about next year.
All right. Thank you, Dr. Sen. I just wanted to, I thought you would have a rival point of view. Well, Neelkant, actually, your point is, kind of endorsed by Dr. Sen as well. I just wanted to ask you another one. You said that the FIs don't have much activity. They account now for only 30% of the total activity. That's what your note says. Therefore, do you think that the growth slowdown, global growth slowdown, is not going to have a big bearing in India? Economy-wise, you don't think we will be impacted?
It's a very intriguing question, because at this point, there's multiple levels of uncertainty. So there is expectation of a growth slowdown for the first time. The IMF's forecasts are starting to come down. I think there is fear that even 2019 for the US could actually be much worse than what is currently forecasted. Anyway, most people think there is a recession coming in 2020. But the thing is, this is happening at a time when the quantitative tightening is happening, or let's say the reversal of quantitative easing is happening. So next 12 months, $430 billion. The next 24 months, almost $900 billion of shrinkage in central bank balance sheets, and interest rate going up. So for the interest rate increases that are budgeted and planned to actually not happen, you need significant market stress and volatility. So for the central banks to adjust to the fact that growth is now starting to slow and there could be sharp downward revisions, you need a lot of volatility. So will it come to India is the question. In the last 3 years, FIIs have barely been net buyers of the Indian market. And as you observed, 5 years back, there were 50% of trading volumes in cash. Now there are only about 30% of trading volumes in cash. So I think the volatility will be less. I think what has been helping stabilize the Indian market has been the $1.5–2 billion that keep flowing into mutual funds. I mean, if you think about it from perspective, the best years, I mean, forget the extreme years, but among the best years in India, $20 billion of FII flows is what you would expect in equities. We're getting $20 billion of domestic mutual fund flows, right? So I think that provides a kind of a stabilizing cushion. In terms of the economic impacts, India is among the least integrated, while our headline, import-export to GDP are very high, but that's very low value-add exports. In terms of actually value-add, we are not that affected. But on the market PE, see, the Indian market price to earnings premium to world PE is at 28%. It's in the last 7-8 years, the peak has been about 35. Okay. So we're very close to that. So if global market PEs come down, then I think we will see some downward pressure as well. So we could see earnings going up, roll forward earnings going up, but the market staying where it is.
Okay, well, Neelkant, we've run out of time. We would have loved to chat some more, but thank you for a lot of these important themes that you fleshed out for us, and have a great Christmas and New Year.
We must remind that Credit Suisse calls in the past have been fabulously correct. Remember, they were the first to call the metal cycle.
Yes.
3 years ago was it at their Hong Kong conference, and thereafter the IT call also was theirs, though it took maybe 7-8 months to fire, but when it fired like hell. Yeah. So now they are calling for L&T, BHEL, SBI, ICICI. Yes. Yeah. So it's important to note that they've got it right many times.
And two people have called out the capital goods and infra theme, right? One is Credit Suisse, and even Shyam Shekhar at our panel on Friday also spoke about it. So let's see how this one plays out.